Welcome to The Deep Dive, your essential shortcut to understanding what actually happened behind the numbers. Today, we're digging into the Q3 fiscal 2025 earnings call for Oxford Industries. That's ticker OXM, which dropped after the market closed on December 10th.
And this call was, let's just say it was critical. Investors were already on edge going in, worried about tariffs, all the promotional noise in retail, and just how some of their internal brands were holding up.
But what they delivered was even worse than people feared, right? The market reaction was brutal.
Oh, swift and punishing. The stock fell over 21% the next day on just massive volume, a really, really bad reaction.
So our mission today is to unpack all of it, the prepared remarks, the slides, the Q&A, to figure out exactly what management said and, more importantly, why the market decided to hit the sell button so hard.
It's really a story of internal execution mistakes hitting a wall of tough external trends.
Okay, so let's start with the top line numbers for the quarter, which ended back on November 1st. It's kind of a confusing picture on the surface.
It is. It's a classic dual narrative. On one hand, you could say they had a marginal beat. Revenue came in at about $307.3 million. That was just a little bit ahead of the consensus, but sales were basically flat year over year.
Okay, flat sales, slight revenue beat. But what about the bottom line, the earnings? Did they manage to protect profits from all that pain?
Just barely. I mean, they cleared a very low bar. Adjusted earnings per share came in at a loss of 92 cents. The street was expecting a 95-cent loss, so technically a beat.
But that's the adjusted number.
That's where the good news ends.
Oh.
Exactly. The real story, the one the market cared about, was the GAAP number. The generally accepted accounting principles. The GAAP operating loss was huge, negative $85.1 million.
Wow. That translates to what, a negative 27.7% margin? That is a dramatic swing.
It is. And it all flows down to that GAAP EPS number, a loss of $4.28 per share.
$4.28. And that's compared to, what, a 25-cent loss a year ago? So what was the one thing driving that massive difference? Was it purely operational decay?
No, the main driver was a noncash, but still financially dramatic. Impairment charge. A $61 million charge.
$61 million.
And that alone was a $3.05 impact per share.
Huh.
But here's the critical part for the market. Management confirmed this was tied almost entirely to the Johnny Was trademark.
I see. So this is them finally admitting on paper that the brand is in serious trouble and needs a complete strategic reset.
Exactly. The market sees that as a final, overdue acknowledgement of a strategy that just wasn't working.
Okay, so if revenue was okay, we have to talk about the quality of those sales, because something had to be going wrong with the margin.
Oh, absolutely. The gross margin situation was dire. It contracted significantly, dropping from 63.1% last year down to 60.3%. That's a 280 basis point drop.
Which is a huge deal in retail.
It is. And to their credit, management was very transparent about it. They directly said that 260 basis points of that drop, that's roughly $8 million, was from the increased cost of goods sold because of tariffs, even after they tried to mitigate it.
So a quantified, painful tariff impact. Okay, so was this weakness just across the board, or were some parts of the business holding up better than others?
It wasn't uniform, and that's a key detail. There's still core strength in their full-price direct-to-consumer channel, their DTC. That was actually up 3% year over year.
And what about their restaurants, the Tommy Bahama experience?
Their food and beverage channel, so the restaurants and Marlin bars, that also grew by 3%. So the experiential side of the business is still working.
Okay, so DTC and food and bev are doing all right. Did the wholesale business just sink those gains?
It absolutely did. Wholesale was down 11% year over year. And most of that decline was in their off-price business, selling to outlets and discounters.
Which tells you that their retail partners are getting cautious, right? They're pulling back on orders.
Exactly. They're probably dealing with their own inventory headaches.
And if we drill down brand by brand, who was pulling the weight and who was dragging things down?
So Lilly Pulitzer actually had a strong quarter, posted positive comp sales. And for anyone listening, comp sales are, well, they're the best measure of a retailer's underlying health.
Right. It's sales at stores that have been open for at least a year.
Exactly. So Lilly and the emerging brands group, Southern Tide, Duckhead, and so on, they all showed strength. But that momentum was completely erased by Tommy Bahama and Johnny Was. Both of them had negative comps.
So you've got these smaller, successful brands paddling hard, but the two big ships, Tommy Bahama and especially the struggling Johnny Was, are just dragging the whole enterprise down.
That's the story of Q3.
Okay, let's pivot. Let's look at the immediate future Q4, the critical holiday season. What was management's tone there?
It was tough. They framed the macro environment as, highly promotional and the consumer is increasingly choiceful.
Yeah.
But the biggest bombshell really was an internal problem. They cited a softer start to holiday because of self-inflicted tariff-related product gaps.
A self-inflicted wound. So this soft start is a direct result of sourcing choices they made months ago when things were even more uncertain.
Precisely. Management admitted that early Q4 comp sales were running negative in the mid-single digits. That's a huge reversal from their prior expectation of flat to low single-digit positive comps.
And it all traces back to the threat of that massive tariff from China.
Yep. They were facing a potential 145% tariff on certain goods.
145%. I mean, you have to react to that. That's a financially paralyzing risk.
You have to. So they made the call to reduce their exposure to categories that relied heavily on China. The problem is, the result was they were left with these huge assortment gaps in key seasonal categories, especially sweaters.
Oh, no. So they were missing the exact product that people are looking for during the holiday shopping rush.
They were missing the essential cold weather product. It's the pivotal detail. The market isn't just selling off because of weak demand, but because the shelves were missing the right product at the worst possible time.
And all because of a tariff threat that has, ironically, now mostly gone away.
That's the painful nuance. But the market just sees the negative comps and the massive guidance cut that came next. And that revised full-year outlook is what really drove the panic.
Okay, let's dissect that guidance revision. It was severe.
It was a gut punch. They cut the full-year sales outlook to between $1.47 and $1.49 billion. But the big one was adjusted EPS. They revised it way down to a range of $2.20 to $2.40 a share.
And just for context, what did they earn last year?
Last year, they earned $6.68.
Yeah.
So, yeah, it's a steep, steep decline.
And they put a specific number on the tariff pain for the whole year, right?
They did. They quantified the net tariff impact at about $25 to $30 million for the full year, or, $1.25 to $1.50 per share. It's a real structural anchor on their profits.
And for Q4 specifically, what are they guiding to for the holiday quarter itself?
They're expecting sales between $365 and $385 million, with adjusted EPS basically at break-even, somewhere between 0 and 20 cents, which tells you they expect those negative comps to continue right through the end of the year.
So let's look at the fix. They said these assortment issues are peaking now in Q4. What's the plan for spring 2026?
They do believe the worst of it is contained to this quarter. The spring 2026 assortment should be much better aligned because that 145% tariff threat is off the table. Now, to fight the financial hit, they're planning on price increases for spring.
How much?
Ranging from 4 to 8%.
Wait, raising prices by up to 8% when you just said the consumer is choiceful and competitors are super promotional. Does that feel realistic?
That is the core tension here. They admitted the goal is just to mitigate the dollar impact of the tariffs. They know it probably won't fix the percentage margin. It's an attempt to hold the line on profit per item, but you're right, they are walking a very, very thin tightrope.
Okay, so beyond pricing, they talked a lot about foundational work. Let's start with Johnny Was, the brand that took that huge impairment charge. What's the plan there?
A major profitability plan. And the biggest move is a leadership refresh. They promoted Lisa Kazor to be the new president of Johnny Was.
And she has a specific background, right?
A very specific, very strategic background. She has over 25 years in high-end retail merchandising, including a decade as a general merchandising manager at Neiman Marcus.
So they're bringing in a merchandising expert to fix what has been, at its core, a merchandising and planning problem.
That's the signal, exactly.
And what about the other big structural bets? Tommy Bahama.
They're doubling down on what works, the hospitality model. They highlighted new investments like a full-service restaurant and store in St. Armand Circle, Florida, and a new Marlin bar on the Big Island of Hawaii. It reinforces that brand experience that nobody else can really copy.
And the big one, the huge capital expenditure project, that new fulfillment center. Where are we with that?
It's almost done. The new facility in Lyons, Georgia should go live in early 2026. And this is vital context for investors because that project is why their CapEx has been so high this year, around $120 million.
Right.
But management made it very clear that CapEx is expected to moderate significantly next year once it's done. That frees up a ton of cash flow.
Okay, so that context is key. But why did the market panic so badly? If all these long-term fixes are in place, why the 21% drop?
Because the market, almost every time will prioritize the immediate forward guidance over anything else. And the combination of that brutal EPS cut and the admission of a soft holiday start, it was just too much. It triggered immediate, heavy selling.
And when you zoom out, OXM stock has been struggling for a while.
For a long while. It's down over 60% in the last year, while the broader retail index, the XLY, has been positive. On top of that, short interest was high going into the call, around 17%.
So when bad news hits a heavily shorted stock,
It's like pouring gasoline on a fire. It just accelerates the drop.
last thing before we move on, any other interesting tidbits from the call about what the consumer is thinking right now?
Yeah, two things. First, just how intense the promotions are. Competitors went earlier and harder than OXM expected. And second, consumers are shifting toward versatility. They mentioned the Tommy Bahama Bora pant sold really well, even after they raised the price.
So versatile items that can be dressed up or down are winning. Meanwhile, novelty items, especially at Lilly Pulitzer, saw weaker demand.
Exactly. When money's tight, people want things that offer more utility. They're making very choiceful decisions.
All right, let's move into our final segment. And just a reminder, this is purely analysis. It is not an endorsement or a recommendation.
This is not financial advice.
So given what we've seen, peak pessimism, peak spending, peak uncertainty, if we were pitching an outrageous but plausible trade idea here, what's the bet?
The thesis is simple. We are at the point of maximum pain. The company has hit this trifecta of bad news. You have peak CapEx spending with the Lyons facility, you have the peak tariff headwind with this Q4 assortment disaster, and you have peak uncertainty around Johnny Was.
And all three of those headwinds should get better by the middle of next year?
They should significantly moderate or resolve, which means the absolute low point for the stock should be when these Q4 results get reported in March.
So the trade is?
A long OXN calendar call spread. You'd focus on a March 2026 versus the June 2026 expiration dates. Basically, you buy the longer dated June call and sell the shorter dated March call. You're betting that the Q4 report in March confirms the bottom, but by June, the market starts to see the light.
And that light is what specifically?
For one, the lower CapEx and higher free cash flow from the finished film in the center. 2, normalized inventory for the spring season without the tariff headwind. And 3, early signs of a turnaround at Johnny Was under new leadership.
So it's a bet on the improving trajectory of the business, not on current demand.
Exactly. It's plausible, given the level of panic we just saw.
Okay, to quickly recap our deep dive. The quarter showed there's still strength in brands like Lilly Pulitzer, but execution was really hampered by those tariff-driven assortment gaps and a tough macro environment, all of which led to the big guidance cut and that massive Johnny Was impairment.
Right. And the company is trying to pivot. They're overhauling Johnny Was, investing in Tommy Bahama's strengths, and finishing up that big infrastructure project. But for right now, the market is just laser focused on the immediate pain.
So here's the final thought for you to chew on. Management plans to raise prices 4 to 8% for spring to offset tariffs. But we just heard clear evidence that consumers are highly responsive to value, and the whole retail world is on sale. So will those price increases actually stick? Or will they be forced to promote anyway, further crushing the very margins they're trying to protect? That tension right there defines the entire risk for this company heading into 2026.